Hi, I'm Jimmy. This is a second video in our valuation series. In this video, we're going to look at how to use the dividend discount formula to calculate the fair value of a stock. You might also hear it called a DDM formula. In our first video in the valuation series, we looked at using the discounted cash flow to try to come up with the fair value of a stock. This technique is very similar to that technique, except this one's actually a bit simpler because there are less assumptions that need to be made. Okay, so let's get started. So in its simplest form, this is what the most basic version of the DDM formula looks like. And the goal of this is to ultimately try to determine the present value of future dividends. So this formula is actually a one-period DDM formula. Ultimately, that means that what is the holding period in this example is just 1 year. What is that worth today? Okay, so what does this formula tell us? So D1 is the dividend, next year's dividend. P1 is the price we expect to sell the stock at next year. And then we divide that by 1 plus R. R is our required rate of return. So this version of the formula actually doesn't do a whole lot for us when it comes to valuing a stock. But it can do a good job of illustrating how the dividend discount formula works and the theory behind it. So, looking at this formula, let's pretend that we're going to value a company. Now, I'm going to use real examples in a moment. I just want to take a second and go through a hypothetical example to illustrate how it works. Okay, so this hypothetical company, we believe that we're going to be able to sell their stock back to the market in 1 year for $100 per share. We also expect to receive $5 in dividends in one time period. So that will give us a total amount coming in of $105. Okay, now our required rate of return, let's pretend that our required rate of return is 10%. So at the bottom, we're going to have 1.1. That represents 10%. If it was 5%, it would be 1.05. Okay, some basic math, and we can calculate that the fair value of this stock is $95.45. And if we think about it, this actually makes a decent amount of sense, because we need to return 10%. That's what the required rate of return is telling us. Well, if this stock, let's pretend it wasn't paying out $5 in dividends, it was paying out $10. Well, then we could buy this stock for $100, assuming we were going to sell it for $100 in a year. And if it paid a $10 dividend, that would be our 10% required rate of return. Now, obviously, it doesn't often work out like this. How would we know what we're going to be able to sell the stock for in a year? Now, if this was the bond market, well, there's a fortune to be made in the bond market because formulas like this are far more efficient over there, where things are a bit more defined than they are in the stock market. But either way, sticking with stocks. Now, what if we wanted to hold this stock for more than 1 year? Well, if we were going to do it for, let's say, 3 years, now the formula is pretty simple. Dividend at year 1 divided by 1 plus R to the power of 1. Year 2 divided by 1 plus R to the power of 2. Same thing for year 3. And then in year 3, in this example, we're going to assume a price that we're once again selling the stock at. So we could use this exact formula for however many time periods we want to use. If we believed we could reasonably forecast however many time periods, this could work. But what if we wanted to hold it forever? Or what if we weren't sure what the selling price of the stock would be at the end? Well, this is another version of that formula. Same exact formula, just a different version of it. And this one's much more usable. The concept is exactly the same as the other versions, except this one's slightly better for stocks. So now we're going to use a real company, 2 of them actually, so we can try to illustrate 2 different versions of the DDM formula to try to come up with the fair value of a stock. Okay, so by the way, with this formula, well, this is excellent for trying to value a dividend ETF. If you've ever been curious how to value an ETF, this works very well for dividend ETFs. So if you're curious, this is also called the Gordon Growth Model. So what are we looking at here? So D0 is the dividends that have been paid out today. So let's say the dividends that have been paid out over the past year. So this information we're going to get from Yahoo Finance once again. And this first example, we're going to use Johnson & Johnson. They're a mature company and they've been consistently increasing their dividends for a long time. And that's sort of the target profile we're after with this type of valuation technique. So if we go to the historical data tab, we can go to this area where it says show historical prices and switch that to dividends only. Hit apply and boom, we have the past year's dividends. And just like that, we add these up and we have how much has been paid out in the past year by Johnson & Johnson. Add these up, we get $3.65. So $3.65 is D0. So now we need G. G is the expected growth rate of the dividends for the long run. So we pull down their numbers again from Yahoo Finance, and then we switch it from the past year to, let's say, the past 5 years. You can go as far back as you want. Well, then we add these up and we calculate what the growth rate is year over year. Well, I calculated some growth rates, and it turns out that the 1 year growth rate is about 6.7%. The 3 year growth rate was about 6.2%, and the 5 year growth rate was about 6.4%. So let's take an even number. We'll call it a 6% growth rate. Now, I'm okay with this because I checked on the financials and I calculated Johnson & Johnson's payout ratio, and their payout ratio, they're paying out about 60% of their profits. So in theory, they'd have a little bit of wiggle room if their profits were to fall, if they were to go a bit high. I think that they can consistently continue to increase their dividends, at least in the foreseeable future. Now we take this 3.65 and we multiply it by 1.06 to represent the 6% growth rate, and that gives us $3.87. So that was the purpose of this entire top part of the formula, to try to come up with next year's dividend. That's what D1 is. We saw that in the previous formula we looked at. Well, if you happen to know analyst reports, or if you happen to have an idea of what dividends is supposed to be next year, you could use that. But either way, that's the goal here, come up with next year's dividends. Now we want to apply that same growth rate to the bottom part of the formula. So I'll just plop in that 0.06 to the bottom. So just so we're on the same page, the growth on the top, growth on the bottom, same number. Now we need R. So R is the required rate of return. Now I went over how to calculate a required rate of return using the weighted average cost of capital and the capital asset pricing model in our discounted cash flow video. But this process actually takes a few minutes. So if you're not sure how to do that, or if that's something you'd be interested in learning, I put a link in the description below to that video. And I set it to, when you click on the link, it should bring you right to the exact moment where we're talking about how to calculate R. But in the meantime, here's some basic data that I'd used for our calculation. And I actually took a more conservative number, ultimately rounding up our weighted average cost of capital to about 8%. So using a weighted average cost of capital of 8%, a growth rate of 6%, that would imply, using the DDM formula, that the fair value of Johnson & Johnson's stock would be about $193 per share. Right now, Johnson & Johnson is trading at about $140 a share. So according to our DDM formula, it would seem that Johnson & Johnson looks like a pretty good deal. Okay, great. But what about a company like Lowe's? Lowe's also pays a great dividend, but their dividend rate increasing on an annual basis has been in the high teen range, call it 17, 18, 19%. So no company can continuously grow dividends by 18% a year indefinitely. Okay, so cleaning this up a bit. So now we have the exact same formula, but now you may notice that we add the L next to both growth numbers. So L stands for the long-term growth rate. And then we add this. This is a transition period. So let's walk through this new formula real quick. So D0 is once again the dividend for the current year. For Lowe's, that was $1.92. Then H stands for half-life. So ultimately, what we're trying to do is we're trying to determine how long it's going to take for Lowe's to decrease from their current rate of, let's say, 18%. How long will it take for them to go to a long-term growth rate of, let's say, 6%? We use the same one that we used over for Johnson & Johnson. So let's imagine that Lowe's is going to gradually decrease the rate that they increase their dividends from 18% down to 6%, and let's pretend they're going to do that over the next 14 years. So the H represents half of that, so there we plug in 7, which is half of 14. So once again, the theory here is that Lowe's is going to gradually decrease their dividend growth rate every year until it hits 6% in 14 years. That's what these assumptions are telling us. So then we plug in the rest of the formula, that is the short-term growth minus the long-term growth, and then we divide that by R minus long-term growth rate. Now notice that the R here, the required rate of return for Lowe's, is different than what we use for Johnson & Johnson. And the reason for that is that Lowe's has a higher beta, so that would impact the required rate of return we would expect. In theory, beta is supposed to represent risk. So beta for Lowe's is higher than it is for Johnson & Johnson, and if you're going to take more risk with a stock, you would expect a higher required rate of return. That's why that number's higher. So we can get all the numbers for the top section from the bottom section. We drag those numbers up to the top, and then we calculate that. Well, that adds about $68 per share in value to our calculation. Just so we know, that calculation is the exact calculation we used for Johnson & Johnson. So if we had applied that exact formula to this, we would have gotten $68 per share. But then when we add the transition formula, that gives us about $58 per share in fair value, giving us a total fair value of Lowe's stock of about $122 per share. Now, if we compare that to their current price of about $100 per share, well, according to our H-model DDM formula, this is called the H-model, well, it seems that Lowe's stock seems like it has a bit of upside. So that just about summarizes the DDM formula. And there's a few more wrinkles that we could look at if we wanted to. But I just want to point out, be aware of the amount of assumptions that are going into this. So you wouldn't want to really just guess like we did here, just as an example. You'd really want to have some logic behind why you were picking the numbers you were picking. And if you're interested in seeing any other variations of the dividend discount model, please let me know. I'd be happy, put those in the comments below. I'd be happy to do other versions of this. Besides that, I intend on further developing the videos in the valuation series. So if there are any valuation techniques that you're most curious about, please let me know in the comments below. And if you haven't done so yet, hit the subscribe button. Thank you so much for sticking with me all the way to the end of the video. I'll see you in the next video. Thanks.